The U.S. Treasury is panicking. I'm your host, Steve Van Metre, and thanks for joining me today. And the major banks are facing a liquidity crisis as the Treasury is losing control of the bond market. Let's over to Bloomberg, where we picked today's story up with the headline, Yellen worries over loss of added liquidity in Treasuries. She notes that the standing repo facility could be help, and she's right. We're worried about a loss of adequate liquidity in the market, she said on Wednesday, as the balance sheet capacity of broker-dealers to engage in Treasury market making hasn't expanded much, while the overall supply of Treasury has climbed, she noted. And she's right. We've talked about this in prior shows, something called the SLR, or supplementary leverage ratio. This is a regulation that's being imposed on the banks by the Fed, which is really keeping them from doing their market-making job in Treasuries. As soon as the Fed pulls that regulation off of them, watch for the big banks to step in a major way. Yellen noted that the Federal Reserve now has a standing repurchase facility to provide liquidity backstop to Treasuries, that it could be helpful. She also said that the so-called Group of 30 panel has presented some good ideas on reforms that would help strengthen the market, including the possible expansion of central clearing. Now, we talked about this last week, but one thing we're missing here, I think that Yellen is missing here, is she thinks that, hey, there's a standing repo facility where that if somebody needs cash, they can take their Treasury to the Fed for a short-term loan and get the cash they need. That's not what this is about. What you're seeing is people are saying, hey, why should I keep this Treasury that I bought, say, near the lows of the pandemic at a very low yield when yields are much higher? I think I'll just take the loss now and I'll buy a bond with a much higher yield. And so what we're seeing on the secondary market is people selling older Treasuries to go and buy the new ones. And momentum builds for creating a Treasury bond buyback program. No surprise, the market is looking for answers, and the Treasury might have one as Yellen goes to the dealers and asks for help. While the Treasury Department has carried out buybacks in the past, most recently between 2000 and 2002, while its industry advisors since have urged it to consider establishing a program, steps taken in that direction last week were more than experts anticipated. So some of you might be wondering is, well, why isn't the Fed stepping in here? Why aren't they doing anything? And that's because the Fed doesn't have the balance sheet capacity to rescue the market in this case. What it would take is the Fed to have a large supply of Treasury bills at their disposal to go out and swap with longer dated notes and bonds. The Fed doesn't have a whole lot of bills relative to the notes and bonds it has, meaning the only place that we can see a rescue now is from the Treasury. But what would this mean to yields? Well, let's go back to 2000 and 2002 to see just how effective this program was. And here you can see what caused the Treasury to do this previously. There was a run-up of yields going into the year 2000, and that wasn't good. Of course, we know Janet Yellen, the queen of low interest rates, knows that higher rates are not good for the economy. But look, back then they said, hey, we're going to take and issue more short-term debt and buy back some of our older long-term debt. And look what happened over the following 2+ years. Yields went on a downtrend, and that's simply because the market came in and said, look, if you're going to buy this old stuff, well, we're going to buy it too and make some money on the deal. And so if the Treasury pulls this off, what we can expect to see is yields to fall. Liquidity metrics for the U.S. government debt market are approaching crisis levels after a year's steep losses for bonds caused by rising inflation and Federal Reserve interest rate increases. And with the central bank simultaneously cutting some of its holding, the situation may get worse. When we warned last week that the Treasury buybacks might begin to enter the debt management conversation, we didn't expect them to jump so abruptly into the limelight. September's liquidity strains may have sharpened the Treasury's interest in buybacks, but this is not just a knee-jerk response to recent market developments. In fact, arguably, this is something the Treasury should have been doing all along. In fact, when the Fed started saying we're going to do quantitative tightening, the Treasury should have stepped in and said, hey, we're going to engage in a buyback program. You'll see why in a minute. It makes perfect sense what Yellen's trying to do here. It's not just to rescue the bond market. It's not just to bring interest rates down. Both those something she wants to do, but it's also because they have all the tools in place to make it happen. The specific step taken by the Treasury was in its quarterly survey of primary dealers, who noted that 25 dealers were asked for a detailed assessment of the merits and limitations of a buyback program for government securities. When the last financing plan was released in August, the department's industry advisors on Treasury Borrowing and Advisory Committee recommend further analysis of the issue, and I can assure you this is something the banks want. The buybacks in 2000 to 2002 were done to allow the Treasury to continue to sell new bonds to maintain market access at a time when the federal government was running a budget surplus and didn't need the money. Funds raised by selling new bonds were used to repurchase old ones. So any notion that you'll hear that, hey, this is money printing. No, it's not. It's just simply issuing new debt to buy back old debt. Now, if you think back as why did this make sense back in 2000 to 2002? Was it some sort of scheme? And the answer was no. When a government runs a surplus, it issues less Treasury bills. Of course, we know from the research of our chief strategist, Jeff Snyder, that Treasury bills are pristine collateral and the system needs an ever-expanding amount of them. So all the Treasury did then was say, hey, you need more T-bills. We'll tell you what, we'll issue more bills and we'll pay off older notes and bonds. And lo and behold, it worked and rates came down. Now we're using the same thing, but to do what the system has been needing for a long time. And that's put more Treasury bills into the system at a time when there's a huge multi-trillion demand for them. And again, the Fed can't solve this problem, but Yellen, she can. Under current circumstances, which include a large federal deficits, a buyback program would have different purposes. They include adding liquidity to parts of the market in most need and allow Treasury bills to be sold in more consistent quantities with proceeds used for buybacks of securities and less demand. And so what you'll see here is happening is if this looks like it's going to gain traction, what you'll see is a bid start to come under the long bond market, because the market's going to say, if you're going to buy these, I'm going to buy them ahead of time and take advantage of that. And that's why investors who are looking at their portfolios wondering how they can recover will look to the bond market and more specifically to a strategy that hedges with it. I'll put a link up here to Portfolio Shield and description below. Let's continue on. Because if you look at what the opportunity is for Yellen and how big this could be for the long end of the Treasury curve, there's $2.2 trillion in what is called overnight reverse repo. Now, as we've talked about in prior shows, this is money market funds that don't have collateral. So the money market fund bill or rate, whatever it's the legal issue, the thing that backs it, I forget the exact terminology of it is, it says that if you hold money market funds, it has to be backed by T-bills. It doesn't specifically say it, but if you said, I want to go follow the rules, you got to buy T-bills. So there's $2.2 trillion shortage of T-bills. The Fed doesn't have that on their balance sheet, but the Treasury could go out there and unload a whole bunch of new T-bills. And could you imagine what would happen to the long bond and long rates if the Fed started going out and said, we're going to buy, say, north of $2 trillion of our debt? What you'd see is long rates crash and the long bond goes straight up. And of course, we know that if this happens, that right now estimates point to May, although I'll gather this will happen sooner, but let's say it happened in May of 2023. Well, we go back and look at gasoline prices here in red on a year-over-year rate of change. They peaked right absolutely notably in May, which tells us that at current rate, if gasoline prices just stay the same, that the year-over-year comp is going to go negative, meaning that inflation will be coming down in a big way. Potentially, we could even see deflation at some point at a time when the Treasury could come out and support the bond market with trillions of purchases. Makes a lot of sense. But it's not just to bail out the bond market, it's the banks who Yellen's also looking out for. As banks wrestle with trillion-dollar bond market dilemma, the pandemic fattened lender securities holdings, but with interest rates rising, the question is now what? The question is, how big are the losses? U.S. lenders currently have $5.66 trillion of securities on their balance sheets, alongside, get this, $3.19 trillion of uninvested cash. Again, imagine this. The Treasury comes out and says, we're going to buy, say, $2 trillion of bonds and notes over time. And the banks say, hey, you know what? We've got $3 trillion in cash. We're going to start buying too. You can see the whole yield curve steepen as rates come crashing down. Their holdings include U.S. Treasury, foreign government bonds, agency bonds, mortgage-backed securities, corporate bonds, and more, notably no mention of stocks. And today, these bank managers, these portfolios face a number of challenges. First, how to tackle an uncertain interest rate outlook. Inconveniently, most of the bank's inflows took place during a period of low rates, presenting managers with the dilemma of whether to buy bonds and lock in low yields or wait till returns improve. So perhaps they're waiting to deploy this cash. Given collapsing securities prices coupled with supersized securities portfolios, banks are now seeing on a record mark-to-market losses. That's right, unrealized losses hit bank capital to the tune of $253 billion at the end of June, according to data from the FDIC. So again, this isn't just to bring liquidity back to the bond market, which of course we know it's in desperate need of. So this also be a big boost to the banks who could deploy some of that $3 trillion worth of cash to buy bonds and front run the Treasury. And that would actually help the banks recover some of their losses and then obviously fix some of the losses they're facing with their existing bond portfolio. But what happens when depositors want their money back? Well, there are signs it's beginning to happen, but if we have a recession, it'll go just the other way. In September, deposits fell by an annualized 9.1%, with loan volumes up an annual 9.4%. The excess deposits could depart quickly as they arrive, but again, in a recession, they'll come flying back. And the odds of that happening are pretty high as home builder sentiment drops to about half of what it was 6 months ago. The National Association of Home Builders and Wells Fargo Market Index was designed to gauge market conditions, fell whopping 8 points to 38 in October from the previous month. Get that, this is the lowest level since 2012, with the exception of a brief drop at the start of the coronavirus pandemic. A rating below 50 is considered negative, and something I want you to be thinking about is the housing market is 20% of the U.S. economy. That means as demand for homes goes down, a lot of people are losing their job. And here we can see just months ago, home builders were exuberantly confident about the market and home buyers outright collapsing, suggesting that home buyers or home builders, their confidence will collapse, which will eventually, at least in the short run, it means they're going to give you more things if you buy a home, and it means they're going to try to buy your rate down. But ultimately, as more inventory gets built and finished, it means they're going to cut prices, and that will drive the resale market to do the same. And here we can see already in today's data, building permits only up 1.4% in September. But look at this, housing starts down 8.1%. And likely that number is to continue lower as home builders are sitting on a record amount of inventory. And what that means for the economy, well, this chart here shows the NHB housing index in blue, and it leads the inverted unemployment rate. Exactly what I mentioned, with 20% of the housing market or 20% of the economy due to the housing market, it means we're headed to a recession at a time when the Treasury is going to be the one, led by Janet Yellen, to bail out the bond market and drive rates straight down. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.